Welcome to the Commercial Real Estate Podcast powered by First National. I'm Aaron. He's Adam. We're recording here live at the Western Canadian Apartment Investment Conference, sitting in Edmonton. Our guest is a return guest, number 3. This is the last. We've just discovered. He'll be canceled after this episode. Paul Chaput.
So as mentioned, repeat guest. We've gotten had great conversations with Paul in the past. He is hyper plugged into the brokerage market out here. I mean, I'll let him tell his story a little bit. I don't want to, step all over it. But the focus of the conversation today is going to be around the buyer-seller market in the Alberta region. He does cover quite a lot of Western Canada, so we won't stick to just this province. But welcome back, Paul.
Thank you. Yeah, excited to be here. Thanks for having me back. Well, I'll let you guys take it away.
I was gonna say, 2 years. Maybe let's do a quick update on, anybody wants to do his deep dive on, Paul's backstory. Please go down and listen to the first episode we did with him. But maybe, since it has been 2 years since we've seen you on here, what's been going on in IPA the last 2 years? What's the update?
Yeah, we have been very active. So IPA, we're Institutional Property Advisors. We're a division of Marcus and Millichap. We're one of 2 IPA offices in Canada. We've got Marcus and Millichap offices in Vancouver, in Edmonton, in Toronto, and Ottawa, and Montreal. And IPA is the brand that we tend to deal with, kind of 20 million and up properties, or more active in that market. It's been an interesting time, coming out of COVID, the market figuring out what the market is, and then last year we saw a ton of activity. In both Edmonton and in particular in Calgary, there was a lot of activity, and as interest rates were moving, it was causing a fair bit of havoc. But we were getting deals over the goal line, and CMHC decided to change the fee structure on loans, which jammed the pipeline and created more uncertainty in the market. And I think coming out of that, CMHC, things are getting through CMHC. The MLI Select program is working really well to create some liquidity in the market. We're excited for this year, 2024. I think Edmonton is poised for a banner year, some good growth, both on the rent side as well as the investment sales side and pricing side. But it's somewhat left behind, chasing Calgary these days.
There's a narrative, at least in Ontario, that everybody's leaving and joining Alberta. Is that true?
Yeah, we just saw the economist that was on earlier. He was talking about Alberta. We're seeing for the first time really ever, both Ontario and BC were net migrants out of province, and it's all coming to Alberta. Some of it's going to the Maritimes, but it's all coming to
and
Alberta,
not because of an oil boom or an oil and gas boom, right?
Yeah, that's the interesting part. It's not driven. It's not so much
It's because Ontario and BC suck, not because Alberta's amazing.
Yeah. Well, I wouldn't say that. Nor would I say Alberta is amazing, but it's really coming down to the affordability factor, right?
Yeah.
And while there are jobs, usually it's historically it's been oil booms, oil companies start hiring anyone they can, and people flow into the province, and here it's good, stable economy. There's economic growth, there's jobs being created, but it's not just the oil sector. It's kind of across all facets, but it's really an affordability thing. You can $500,000 gets you a 4-bedroom house in the suburbs in Edmonton, and I'm not sure what it gets you in Toronto.
An annual mortgage payment in Toronto.
Yeah,
or exactly. A 300 square foot micro unit.
Yeah. And so I think as the demographics show, I think Alberta, about 4 years ago, the boomers, the millennials are now, there's more millennials than there are boomers, right? And the boomers are declining, of course. but in the rest of Canada, I think that's just happened in the last year or two. So it's we've got a young province. The people that are moving here are the biggest 5-year cohort. Again, I'm peeling from The Economist earlier, but
That sounds smart though.
Yeah. He had some gold. He had some real gold. I think 25 to 29 was the most prevalent, and so those are people, arguably really getting into their careers, really looking to start a family if they're not already on the cusp. But those are some really, you've completed college or whatever, you've moved into some sort of career path, and now you're making some real life decisions and where you're starting up your family, and some big decisions that are going to kind of keep you where you're forming roots in that age group. So it's
that's got to be a better base than people streaming in from the East Coast to work in oil fields than departing the minute the price of a barrel tanks.
Absolutely, yeah. We've seen it before. Where I think it was 2016. We were touring some properties out by Lloydminster, and this truck with this jacked up truck with a quad in the back, and I think a couple other toys in a trailer behind it. Was heading back east, right? And they're not coming back. They made their money, they got their toys, they're moving back to Ontario and not coming back. And this feels like a very different draw. It's drawing a different person, and we'll see how sustainable it is. But so far, it is having an impact. Everything is rising. House prices are rising, rents rising. Calgary really started 18 months ago. Edmonton really started kind of 6 months ago. And so Edmonton generally trails Calgary by 12 months, if not 18 months. Calgary's really been ripping. Like, coming out of COVID, I would say the rent differential was about 5%. If you're trying to compare, downtown high rise new to downtown high rise new, you're in that range. I'd say today, and Edmonton's doing its best to catch up some ground, but the rent differential is probably about 30% between Calgary and Edmonton.
Sort of a split. I'm sitting here thinking, have you learned the lessons of the rest of the country, where the increase in rents is a precursor to major obstacles, and so where are land prices? Where's the development market? Like, what's transpiring right now?
It's in both cities. It's sort of the tale of two product types. In Edmonton, central infill product, high density product. We just don't have the rents to spur more development. So there's a few buildings that are under construction right now, and then it's a real dearth of product before we see any more. And we're searching for $3 rents in Edmonton on that kind of product.
Is that the over-under for viability?
It would probably be $325, $350 a foot if you're trying to put a shovel in the ground today.
Okay.
So
and that's not achievable.
It's not happening. Whereas Calgary, we're at $350 a foot, and it's starting. We're hearing whispers of $4 a foot, and frankly, like, build costs are a little bit higher in Calgary. Hard costs are a little higher. Labor costs a little bit higher, but you're not. That's 30% right there between $3 and $4, right? Like, that's 33%. So it's I think we're going to see continued smart development. It still takes a lot of guts and a lot of faith and a really good team to put together some of these high-rise deals. But I think we're going to see more of that development activity in Calgary.
Is that availability of land? Is that land pricing? Like, how's the
process?
Yeah.
You know what? Kudos to both Edmonton and Calgary. The entitlement process is not strenuous. If you're a longtime builder in Edmonton or Calgary, you complain, you bellyache about that. But when we talk to a Vancouver developer or a Toronto developer who's looking out west, and they're like, well, you can rezone a site in 9 to 12 months, like fully rezone it. And they're like, yeah, I might. Like, you got the right team. You could start rezoning it during your due diligence, and by the time you close on it, you could nearly have it done. So there's a lot of it's it's business friendly markets as they're reported to be. We believe that they're still there. But yeah, like on the land transactions
It's not happening
it's
yet.
not happening. There's I think Calgary has, like, in the core, there's a lot of big land positions that are owned by developers partnered with Oxford or Aimco, or so there's some pretty hefty land positions that may or may not get worked through. So we're not seeing a lot of land trade. There's not a lot of need for it. There's essentially,
Well, those owners you
big
mentioned
groups.
are not going to be forced into a sale anytime soon. It's
not forced into a sale,
yeah.
and not forced into developing for the wrong reasons or the wrong metrics, or the doing anything. They're also not exactly risk takers, right? Like I appreciate the pension funds aren't supposed to be risk takers, so that's how it works. It's those merchant developers, which Edmonton is more of a merchant builder, at least the core. And the rents are pointing in the right direction. And we could the other thing that could happen is right now you've got to develop to a 4.5 cap at least, if not a 5 cap, because hopefully rent growth will get you a little bit further along. But if we see interest rates decline, we could see groups looking at a 4.5 cap all of a sudden look really attractive. Right now, you're putting 4.5% debt if you're using CMHC on these buildings. It wasn't that long ago we were in the 2% range. If we peel back into the 3.5% range, does that justify a 4.25 cap? And that's where some of the numbers we may.
What did the
see
economist this
development
morning
again.
say?
Oh, he wasn't.
bond
He wasn't
predictions?
making bets on interest rates that I saw.
Short term rates are coming down. That's the
Yeah,
But unfortunately, we don't rely on short-term rates for CMHC products.
if
so
you've
that's-
got
that's
floating
an
rate
issue.
debt on your
Yeah.
land, you might be
Yeah,
benefiting.
might be saved.
No, but your math makes sense. Like if you can get that 4.5 plus some rent increase, you can get into positive leverage, and that can explain things. So, how are you guys doing this year? How's business?
Business is great. Business is really booming. We did, I think, for the first time ever, we did more business in Calgary last year than Edmonton, or on par. And those markets, like, everyone wants Calgary, everyone wants to live in Calgary, but Calgary actually has half the amount of rental product, like half the rental universe that Edmonton does. So it's always surprising. It's even surprising to say that. I just say it enough that I know it to be fact. But it's pretty rare that the transaction activity in Calgary is on par with Edmonton. There's just more available product.
And is that
in
IPA specific,
Edmonton.
or is that like all kind of brokerage?
The markets
specific?
were, like, I think Calgary saw about 600 million in transactions last year, and Edmonton saw 700 and change, which that's about as even as it gets. So yeah, for our team, like, we specialize in selling apartment buildings, and we do a fair bit of land, but really our home base is Edmonton. Edmonton and Calgary is the vast majority of our business, but we'll get as far east as Winnipeg and as far west as Vancouver Island. But really, Edmonton and Calgary are 75 to 90% of our business from year to year.
What's the buyer and seller profile look like? Who's actually out there doing deals right now? 'Cause I know some groups are sidelined, so who is actually active on both sides of the
the
table?
active groups? So a few years ago, pre-COVID, maybe even 5 years pre-COVID, we started to see institutions like the pension funds, fund advisors, saw them get really active in Edmonton and Calgary. That has really flipped on its head in the last 24 months. The institutions have really backed off the market, and frankly, they're net sellers these days. It's really,
Why is that?
I've heard a few things. Again, that the risk profile.
I've heard headline risk. They want out of apartments.
Yeah.
They're just saying, you know what, with the affordability context, like, this housing crisis is not going to be turned off. Like, it's a decade or longer before it stops being one of the first or second political issues. And I think they're just saying, I'm a pension fund. A lot of my pensioners reside in these places. I do not want to have any exposure to
Well,
picketing renters picketing, saying down with Aimco and their high rents, right?
Or
whatever it
regulatory risk
Yeah,
that comes
right.
with it. Yeah.
You know what? Out here, we get a lot less of that. I think for us, or what the institutions are seeing is institutional grade product. So that's those shiny new high rises. They don't make any sense right now. Like they've been underwater for the last 24 months, and they're starting to make sense again. It's just they're some of them are really big bets. Like there's a few towers in Calgary that you're $250 million to buy one, and there's a second tower coming up right beside it, right? So that's $500 million.
Yeah, but with net migration positive, like you just talked about, diversified economy, growing young generation, like you got to be able to back yourself into. Maybe it's not a 10-year ROI, but a 15-year ROI that makes sense, right? Like.
Yeah,
and those guys are not selling in 10 or 15 years typically, right? For the new builds.
And so what I think we were experiencing, so that capital also is very mobile, whereas local regionals or groups with specific ideas, high net worth privates, they're very targeted. But we've heard and we've seen from a few groups that the institutions selling certain assets, they can then take that capital and redeploy it. So we've heard redeploying into the States, like during the regional banking crisis, you were getting AAA product and able to put like 50% loan to value, and maybe that loan to value was declining, but 50% loan to value with a 10% coupon, and that's a pretty attractive. But you, as a local regional, you're not seeing those deals, nor are you even capable of moving your money down there in any sort of like, it'd be a bit solving a Rubik's
Cube.
The
regulatory,
to figure out how to get down there.
It'd be impossible.
So, that's more than anecdotal, but seeing capital leave Canada for other markets that are just more lucrative. But yeah, less so concerned with not owning apartments. I think it's a combination of, that like the $250 million asset was a 4 cap to make that number work, to make it at minimally profitable for the developer to sell. And in the meantime, interest rates have gone from 2 to 4.25, 4.5. So those were just deals underwater. And unlike Vancouver and Toronto, that negative leverage is the only way to do a deal in those markets most of the time. We've never seen that. Like it's not really, and maybe it's small time thinking, but it's just not something that gets done out here.
So speaking of underwater projects, have there been any, call it disorderly exits from real estate of note?
Not really. Back to that same scenario. A 4 cap makes it profitable for you to sell, but chances are you've got pre-existing debt or whatever that helps you carry it. You can carry it through. You just can't liquidate and go do your next project. So we're not seeing a whole bunch of distressed transactions or anything like that. We had one, but honestly, any distress is probably specific to developer operational developer error, that kind of stuff. Less so.
It's usually sponsorship. Yeah, it's usually sponsorship. But if rates stay at 4.5%, like you talk about that individual that needs the 4 cap to get out to repatriate their capital, and it just never turns into a positive yield.
There's a chance that the bank owns it at some point, but I don't. In Canada, it feels like banks are really leery to do that. I don't know how many loans you gentlemen take back in a year.
But I mean, you would see it. Is there not an increase in power of sale happening? Like even a modest increase?
Not like we've had like we just had a sale of frankly, it was a mixed use project that was a hotel that was under development with a small land lease parcel attached to it. Not multifamily, and inexperienced developer that was just out over their skis. And on the multi side, everything's a little bit more buttoned down. It's really one-off. It's really
curious.
one-offs.
I mean, I don't think it's happening to any grand degree in Toronto either. Adam, you correct me. if
No,
you
I
think
mean, like
differently.
you see small isolated ones, but it's not high profile
Yeah.
projects. And it's,
Like I can tell you, like in our we've got 5,000 apartment buildings under management, and so we always have a little bit of
Yeah.
stuff going on. It's almost exclusively operator related,
Yeah.
and our instances of delinquency is up modestly, like just like barely up.
but from rock bottom Canadian levels, like it's not a big part
like
of this
it
market.
doubled.
Yeah.
It went from 0.01 to 0.02, right? Like it's just it doesn't make a difference. But like I will tell you, like your counterparts in Ontario and probably others have been advertising their power of sale experience, their receivership
Yeah.
experience, but I don't think that's actually materialized.
No, we're like, hey, we love that business. It's a guaranteed sale. And we do it. But yeah, no, if I'm thinking kind of year over year, like I think during COVID we were expecting more of that business. Honestly, like,
Do you think
most
it's
of
coming?
it,
Do you think it's coming?
you know, are we talking 5.5% rates? Like if there's something, I think if something weird happens in the market, like right now, groups can so suburbs in Edmonton, you can build these projects to a, you know, your all in cost, you're probably a 5.5 cap, and I can sell it for you for a 5 cap, and there's a bit of profit in there for you, right? Like no one's hitting it out of the park, but builders can continue to build, you know, and when a builder stops building, they're now just a real estate holdco or a vacation co and waiting for the market to come back. So, you know, we're seeing out in the suburbs that there's enough activity that it's moving itself through the market. None of these groups are really getting stuck, and I think something structural in the market would have to change. I can't see rents dropping through the bottom, but maybe there's a scenario where that happens.
Income's not rising rapidly anytime soon, but I don't think that
Yeah.
that matters, right?
Well,
it's
and-
not going
and-
down.
Unless so here because of the lower rent. Yeah.
Yeah.
Well, and you have like, you know, in Alberta, you have like MLI Select, their program of affordable rents being 30% of the average income. Like Edmonton is over 1,600 for an affordable unit, and Calgary's over 1,700, and the vast majority of the vintage stock, like the legacy stock, is well below that, right? So you can, like, there's plenty of groups buying buildings with $1,500 rent that can put MLI Select on it,
and are happy
and are
earning
happy with-
$1,500 a month.
Yeah, and
And the
you know,
tenants are happy paying $1,500 a month because the alternative is
you know,
yeah.
and you know, the question being, is that going to be short-sighted down the road, right? Like as rents, and we're starting to see it, especially in Edmonton. We saw it in Calgary last year. Rents are really starting to take off. Now you've kind of cut yourself off.
You got to
at
hope
knees.
with the entitlement process being as quick as it is that there's a faster response.
Supply can meet demand in a shorter time frame.
I think Edmonton and Calgary have the chance of doing that better or as good as anyone. But
Anyone
there's
building modular?
Well,
You're seeing none of it.
we see there's actually in Alberta, there's a great group, Eagle Builders, that build a modular concrete product, and they're rolling. They're you know, multifamily is sort of the last conquest. Like they build bridge parts, and it gets
I only ask because that will go from a 18-month development time frame to
Yeah.
7 months or whatever it is. But anyway,
No, and I think still making it economically, you know, it's great product.
it's hard to finance.
It's
It's almost impossible to finance.
Yeah.
That's the problem.
Yeah.
Honestly, it's because it's all off-site, so I don't have any security. Anyway,
Yeah.
I don't want to take up.
That's it.
We have an,
Yeah,
we have an episode coming out on that
We'll do-
topic.
yeah, we'll do
actually.
it.
If you like
10% of the
modular,
build
yeah.
value,
If you like
yeah.
modular, we just had a modular consultant on it.
Yeah.
You can probably go find it in the
Okay.
list
Yeah,
below.
we're not seeing it en masse.
Yeah,
It's still you know, on-site build is generally the way, and Alberta, there's a lot of wood frame construction. You know, all the low rise and below six story or below is really all wood frame.
And that's pretty quick.
Yeah. It's 12-month build as opposed to 24 or more.
So you've been comparing Calgary and Edmonton. What about suburbs and urban?
Yeah, I think at Edmonton, there's a drastic contrast between urban and suburban. Suburban is still working well. It's still very affordable. And there's still plenty of activity. So there's lots of supply going on. I would echo that for Calgary as well.
Is that just 'cause land availability? There's 6 stories, so it's stick build. It's just kind of ease of execution.
Ease of execution. Almost everything, like deal size, right? Like you're 150 units at, you're 150 units at 200 a door on cost or something like that, right? A $30 million deal. You guys will finance that all day long. But if I come to you with, okay, I'm building on this tower site in Edmonton, and I need $3.50 rents, and today they're $285, and I'm building 300 units at a build cost of $350 a door. Yeah, you're shaking your head at me, right? Like it's
a little credit heartburn there.
Yeah. I can see your blood pressure rising. Yeah. So it's you're looking at on top of, it's like risk on top of risk, right? And so until the math really makes sense and can really satisfy gentlemen like yourselves, then groups won't get the financing to go ahead, and it'll probably prevent them from making a bad decision or a decision.
Someone out there will do it. It's just, it won't be us.
Yeah. No, it's so centrally in Edmonton, it's really hard to put a shovel in the ground. Hopefully that's changing. Suburbs, I wouldn't profess to say it's easy, but by comparison, it's doable, and groups who are apt, are good at it are doing it. Calgary. You would think with all the interest in Calgary, everything would be buildable everywhere. Centrally, it's a challenge. Different groups have different cost base of their land, and there's some really big kind of master planned, full city blocks of downtown land, multi-tower developments, and those like if those were back to $30 to $50 million deals, great, but they're $200 million deals, right? And so that creates a bit of heartburn, but the math on those is working. It's just not working so well that you're just confident that 200 million will just drop 200 million on this. But out in the suburbs, if you can find land, Calgary's a lot tougher to find available suburban land. That's making a ton of sense.
So you list a land site tomorrow, like you're going to see activity on it immediately.
Yeah. Well, if it's in the suburbs and it's already zoned in the title, like there's a lot of greenfield development in both Edmonton and Calgary. Edmonton more so. That price right, it's gone. Edmonton, you're $1 million, $1.2 million an acre, maybe even a little bit higher. Calgary, you're $1.5 million to $2 million an acre for the same product, maybe even a little higher depending on exactly where. But I'd say those are gone.
And where do the rents spec out?
You're $220, $225 a foot in Edmonton, $265, $270 a foot in Calgary, maybe.
It's not a huge difference between suburbs and urban then, at least in Edmonton.
In Edmonton, no, but so you've got 50 cents in differential, and you've got 30% higher build cost, plus like all the other risks that you're taking on with that, a longer build cycle, and a bigger asset to begin with. As we
that's just part of the culture, the vibe of the culture of the downtown core. Right, like Calgary's got a little bit more of a vibe, walkability score, if you want to put it that way.
There's a few things, and playing in both markets, like we're really seeing it. Like Calgary is really, their downtown is really accelerating past Edmonton's. Edmonton, it did a lot, and especially having the arena, it did a lot to really up its game. But then COVID hit, and coming out of COVID, Calgary City Council has been incentivizing developers to redevelop obsolete office buildings into res. We're not doing the same thing here. We're without getting too political, we're sort of catering to some of the society's problems right now, and it's not helping to fix what we need fixed. It's making it we're having the effect of falling behind, and you go too far down that road, and all of a sudden people don't want to set up fancy new restaurants in downtown. They'll do it. They'll do it in another area or out in the suburbs or something like that. So it's Edmonton and Calgary have, I think going into COVID, had similar downtown excitement, and I think Edmonton's got a real uphill battle to gain any ground on Calgary. It's lost a lot of ground from downtown to downtown.
What market shift for both markets would throw gasoline on the fire? What would kind of break the dam and really take it back to maybe call it the glory days of Alberta?
Yeah, I think really, if we, I'd really hate to see rent growth accelerate too fast, too far, and create all sorts of affordability issues and whatnot. But if we had interest rates just doing what interest rates were supposed to do at the start of the year, and start peeling back, and if there was something that made them, if we shed a point tomorrow, right? Like if 4.5%, interest rates went down to 3.5%. Well, all of a sudden, the deals that are just on the cusp, which there's quite a few, and I think a lot in Calgary, that the strike price is just outside of where someone's comfortable, given where they've got to put debt on it. That could allow for some cap rate compression, and if there was some strong cap rate compression, that might
Yeah. I hope you're right, but I just don't think so. But I've said it so many times now on this podcast. Like, it's just, I just don't think it's happening. But
for sure,
I hope I'm wrong.
At this conference last year, I'm sure we were talking about interest rates coming down any second now, and here we are a year later, having the same conversation.
Yeah. You know what? I think that as much as we're our own nation, we're tied to the U.S. And so until the U.S. feels the need to start lowering theirs, we're probably going to stay where we are, or maybe within a 25 basis point differential of where we are today versus where they're going to bring us. So, I don't know. I was just in the States paying $40 for a cocktail. Like it's I don't know. They're not slowing down by any stretch.
Yeah, the economy's just booming, right?
So
We're just about out of time. What's this time next year at the conference? What are we talking about for pros and cons of this market?
2% interest rates.
Yeah. I think continued rent growth. I think I'm really optimistic that there's some cap rate compression via lower interest rates. I'm not going to bet either one of you that's going to happen. I'm not sure that you would anyways, but
I don't want to win that bet.
Yeah.
Right.
Well, I think that there's looking from 60,000 feet. There's a lot of positivity in both Edmonton and Calgary, and you don't even have to break the dam to see that it's all trending in the right direction. Even my soapbox on Edmonton's downtown, there's a lot of things happening that it's getting better. So hopefully next year there's a whole lot more activity in Edmonton's downtown. That's because of good economics, not because it's been
An Oilers Stanley Cup run would help, wouldn't it?
Oh, well, that part's just a guarantee, I believe.
Yeah, but for the context, we're going to date this. It's May 7th, and Edmonton starts their second round against Vancouver tomorrow. Yeah. If this goes out in a month, at least people will know where we are in the time frame.
Yeah. There's a whole lot of optimism in this city about the team this year. So,
and that does have an impact, right? Like, that could create a whole bunch of energy downtown.
If you're a bar owner, it's just a godsend.
Yeah. And it's and it coincides with, in spring in Edmonton, 3 weeks ago, 2 weeks ago, it was snowing and it was melting, but, we're heading into actual spring where we get rain and there's no snow. So there's a lot of excitement around the city, and it's nice to see the bars and restaurants all full, and lots of blue and orange around, and hopefully it's a deep run this year, and Maybe even the cup.
Yeah.
I like it.
All right. You heard the market prediction on the hockey front.
I'm calling it cup.
Yeah.
2024 Oilers cup.
Paul, thanks so much for coming on for your third appearance, and we'll have to pencil in your fourth. We want to thank, of course, First National for powering the podcast, the Real Estate Forums for hosting us here today at the Western Canada Apartment Investment Conference. Once again, to our guest, thank you so much.
Thanks, guys.
Thanks, Paul.
Yeah, thank you.